How's it affecting the markets? What's going to happen next? Well, that's what we're going to talk about in today's episodes, folks. So without further ado, let's get to the breaking news. So here's what we have. We have right through here. Well, let's go to this first. Jobless claims tumble to 218,000. That's good news for job seekers and the jobs market. It's not good news for mortgage rates. I'm going to show you how the bond market's reacting to that. But let's go over the numbers first. We go through here. Here's what I wanted to focus in on, the jobs report. The reason for that is, remember the Federal Reserve when they cut rates? We go over the captions and when they tell us why they cut rates. And the reason why they cut rates is because of the deterioration in the jobs market. Remember we had like a month ago, there's 1 million jobs just vanished. And then a couple weeks ago, we had another revision of another 250,000 people. So they were thinking there's going to be massive layoffs. Well, the data that we got today is not pointing that way. It's actually giving good news for the jobs market. That's not good news for Fed rate cuts. So let's get over to the data so I can explain it to you. Let me get my head out of the way for a second so you guys can see the data. Here's what just came in. Initial jobless claims. Last reading was 232,000. Okay, it was expected to go up from there to 233. It actually dropped down to 218,000. The good news here, though, is right through here. Continued claims. They're not piling on top of each other. Yes, they're over 1.9 million, but they're not increasing. Okay, so that's the good focal point. So this now tells us, okay, maybe the jobs market isn't so bad. So what the Federal Reserve's going to do? Well, they came over here and they're like, okay, the unemployment rate's probably going to spike up to 4.5%, maybe 5%. We got to cut. Well, based on this news now, maybe they don't have to cut. So let's see how the bond market's reacting to this. Oh boy. So how you read this market right through here is, if you're new to my channel, we focus in on this bond right through here. It's a mortgage bond that trades on Wall Street. This is basically what determines your mortgage rate. This, what we call LLPAs and profit margins at the bank. What you have to understand is that if the price of this bond goes down, rates are going up. So this means rates are going to pop up maybe about 0.05 today. So we'll be back at 6.4, maybe back to that 6.5 range that I've been saying would be in Q3. And that's where we were. And we came down quite a bit off of that right before the Federal Reserve cut. This was like 6.125 or 6.2. Then all of a sudden when they cut, it turned around once again and started increasing from there. How high are these going to go?